And thing number three this morning, watching squiggly lines. That's what Brian Cheung has been doing, and he wrote about it in this morning's morning brief. And when we talk about squiggly lines, we are talking about the yield curve, which, Mr. Cheung, in your signature fashion, you sort of deconstruct it for people, explain to people why it is that we are watching that. So why is this such a focus, and do people have cause for concern here?
Yeah, well, I mean, in finance news, there are a lot of squiggly lines, but one that everyone is talking about is the yield curve. Oh, yield curve inversion, we're going to enter into a recession. But really, essentially what it is it's just a line. So why does the shape of it really matter? Well, this squiggly line is okay. All right, so this is a yield curve that we're looking at from December 2017, generally perceived to be a more normal dynamic. And what you're looking at is the map of yield of treasuries of various durations to see how people view duration risk. When you see the line take this type of shape, instead of a nice upward slope like we just showed you, kind of this weird funky shape where it looks like maybe the squiggly line had a few too many Bud Lights, that's when you start to get concerned because you're seeing the 10-year yield, for example, lower than the 2-year yield. Normally, longer duration associated with higher yields than others. So this is really where you want to see, kind of the issue arise here, because that inversion that we just showed you tends to precede a recession by about 24 months. Now, this is what we're looking at right now because the example I just showed you came from 2019. This is the current status of things when you take a look at just the difference between longer dated treasuries like the 10-year and shorter dated treasuries like the 2-year. We're getting a lot closer to the inversion, which would be reflected by that chart that I just showed you dipping below zero. Now, that hasn't happened yet, but obviously we're below 20 basis points in terms of the difference between those two yields. That could indeed be a concern. Now, other side of the coin would say, look, the Federal Reserve's fingerprints are all over this curve, and that's because on the front end, Federal Reserve's raising interest rates. That tends to correlate very strongly with movement in the shorter end of the curve, like the 2-year Treasury. And then on the longer end of the curve, the Fed hasn't yet begun the process of reducing the amount of longer dated Treasuries that it's directly holding on its balance sheet. That process is expected to begin later on in the year. So maybe this spread that you're looking at right now will actually tilt back up once the Fed begins that process, perhaps in May or maybe in late June. But either way, the concern about a recession coming as a result of the yield curve inversion appears to be overstated. So again, if we do see some sort of inversion in the following weeks, maybe that's very quickly undone by Fed policies in the coming months. But again, when you have something that has a track record of calling 8 out of the last 8 recessions, that's the reason why people are talking about it, and a reason why that squiggly line has some people with a little bit of indigestion, guys.
Yeah, I think that's the top squiggly line for Wall Street, at least right now. We know it does tend to change. Thanks, Brian. Appreciate it.